Hi guys, welcome back to Mr. C's Accounting, and today we're looking at ways of disposing of fixed assets. So getting rid of them. There are three ways to do it. The first is called retirement, which is a nice way of saying throwing in the garbage. The second way is to sell, which is the way that most businesses want to dispose of fixed assets is by getting something for them in the ways of revenue. And the third way is called exchange. Now, BT-dub, we don't really look at exchange in this course. Even if our learning material wasn't restricted by COVID-19, we still wouldn't look at it in great detail. It's fairly complicated and very subjective in terms of what's being exchanged for what, and if there are complementary exchanges of either goods or cash or services or whatever. So it is a complicated endeavor, so we don't look at that this year. And some nice illustrative pictures to give you some visual stuff. So yeah, the idea here of retirement, where when someone retires, they stop working. And so the notion is that when an asset is retired, i.e. it stops working, then it's disposed of. Not the nicest words for it, but retirement sounds better and more official than throwing out. So we say retirement. So no matter which way you dispose of an asset, the net book value must be removed from the accounting records. Because when you're disposing of an asset, its value is being disposed of as well, and so that value needs to be disposed of properly, and accordingly, depending on which method of disposal you are using. But anyway, regardless of how you choose to dispose of your capital assets, the net book value has to be removed, and no matter which way you are disposing of assets, you will always have to deal with debiting the accumulated amortization to cancel it out, and crediting the asset account to delete the asset's value. So generally speaking, we will have to do both of these things regardless of which method of disposal we use. So first off, retirement of a fixed asset. Essentially, the business is throwing out the fixed asset. So, for example, on July 1st, company ABC, what a fantastic name, retires its computers that cost $20,000. Now, we also need to take note of the accumulated amortization of the computers, which in this case is $20,000. So they've been fully amortized, they've been fully used over their useful life expectancy, and the time has come to get rid of them. So the entry for that would be to debit accumulated amortization and then dash computers to show which capital asset we're referring to, because businesses will have multiple capital assets, so it's important that we identify them. So debiting accumulated amortization, computers, $20,000. That's hard to say. And crediting computers. Now, in this case, where the account name is the name of the equipment, usually it will work this way because most capital assets will have an account of their own. The accounting equation is balanced, all is good, and the value of the capital asset has been deleted from our books properly. But usually disposing of an asset is more complicated than that. Side note, if you're still using a fully amortized asset, i.e. it has not been retired, the asset and accumulated amortization continue to be recorded, but we don't amortize any further. So once we've amortized the full amortized expense, remember we talked about how a portion of the asset has a salvage value, and the difference between the cost and the salvage value is the amortizable value, or I forget the term, but you guys know what I'm talking about. We record the accumulated amortization, the full amount, and the salvage value, and we just don't change it. So now we get into the complications. So what if the asset is retired before it is fully amortized and no residual value is received? So when this happens, we have what's called a loss on disposal. And, that name makes a lot of sense because we're disposing something at a loss. We haven't gotten our full value out of it. We're not getting our residual value out of it. So we're making a loss on this transaction. And to continue our example, if company ABC retires the same computers on July 1st, however, the accumulated amortization to date is only $16,000 and nothing was received for the computers, then we have, in general, we have either a gain or loss on disposal. Whichever one of these will depend on if the asset was sold, and if so, for how much. So our gain/loss is shown in brackets, by the way. That's why it's bracketed. You could think of this as a negative, like negative 4,000. We put it in brackets to show that it's negative. So anyway, the gain or loss on disposal is equal to the proceeds from the sale minus the net book value. And the reason the formula is written out this way is if the net book value is greater than the proceeds from the sale, meaning that we sold it for less than it's worth, then we'll get a negative amount, which makes sense, right? Because we're selling it for less than it's worth, so we've taken a loss. So in this case, therefore, the accumulated amortization is $16,000. The cost of the computers was $20,000, and therefore we have lost $4,000. Now, bear in mind, whenever doing these things, the accounting equation, as always, has to balance, so let that be your guide. We debit the accumulated amortization because we're getting rid of an expense. We debit a loss on disposal because this is an expense. And then we credit computers because we're deleting the asset account. So previously we would have had an asset account for computers worth $20,000. And now the reason why we write it credited is because we are deleting that value. So this loss on disposal is recorded in the other expenses and losses section of the income statement. And the loss represents a catch-up of amortization expense that was previously too low. Whoa, where'd it go? There we go. Okay, so the other way of disposing of a fixed asset, the sale of a fixed asset. Gain on disposal is equal to proceeds of sale greater than NBV. In other words, the way this is written is a bit misleading. What I meant, or what is meant here, is that we will have a gain on the disposal if proceeds of the sale is greater than the net book value. But remember when I explained this formula earlier, if the proceeds from the sale is in fact greater than the net book value, remember the formula was proceeds of the sale minus net book value. If that's the case, then we'll have a positive number, right? Because we're selling it for more than what it's worth. So we'll have a gain. Similarly, if we sell it for less than it's worth, then we'll have whatever we sold it for minus whatever it's worth. And if it's worth more, then we'll have a negative value or a loss. So in our example of the fantastically named ABC Company, if ABC Company sells a vehicle for $15,000 in cash on July 1st, the cost of the vehicle, let's say, is $30,000. And let's say at the time of January 1st, the accumulated amortization is $28,000. So there's a lot of accumulated amortization already. And note here, and you'll probably run into this in future problems, wink wink, that the date of sale doesn't coincide with the date of purchase. So there's part of a year in here that we have to account for. In this case, the amount is 6 months. And so we need to find the amortization rate. In this case, it's given to you of $2,500. So the total accumulated amortization will be $30,500. So I got a little bit ahead of myself, but when a sale is made on a date other than the purchase date, and by that I mean it doesn't occur on the same date in a later fiscal year, which it never will, then we need to debit our amortization expense, because remember, it is an expense after all, of whatever the unrecorded amortization is. In this case, like we said earlier, it was $2,500. We then credit accumulated amortization to the vehicle of the same amount. So this is just catching up our amortization expense before the capital asset is disposed of. Step 2 is calculate the new net book value. We need this in order to decide whether we're gaining or losing, right? So the way we do that is we have our new net book value is equal to cost of the vehicle, $35,000, minus the accumulated amortization we had at the start of the fiscal year, $28,000, plus whatever the difference is between the start of the year and the sales date. In this case, it's $2,500. And so $35,000 minus this sum is equal to $4,500. And this is a positive value because this is less than that. So in this case, our new net book value is equal to $4,500. Now, we substitute this value into this net book value because whenever we sell something, our net book value is whatever the net book value is at that exact date. So we need to find what it is at that exact date, which we've done up here, to use in this equation. So gain on this disposal or loss, depending on what the values are, is equal to the proceeds. By that, we just mean sales revenue. So that's $15,000 minus the net book value, the current net book value at this exact date, which is $4,500. The difference is $10,500, which means that we've had a gain on disposal. In other words, we've made money by disposing this product. Or I should have said this asset. So, step 3, record the sale and gain or loss on disposal. So to do that, we're debiting cash because we sold the vehicle, and as far as we know, we were paid in cash. If we weren't paid in cash, then that would have to be addressed here, and the entry would be made accordingly. And then accumulated amortization of the vehicle, $30,500. And then our credit entries, we credit the vehicle. Again, this is an asset account that we are reducing the value of by crediting it. Remember how there was how there was an account for computers? There's also an account for vehicles as well as equipment. So we credit the vehicle account by its cost because we're getting rid of it. And we credit the gain on the disposal of $10,500. This is affecting owner's equity, by the way. That's why it's being credited here. So, the gain on disposal is recorded in the, quote, other revenues and gains section of the income statement. So that's another new account that we'll see in the income statement. Okay, so let's look at loss on disposal now. And again, this equation is written a bit misleadingly. A loss on disposal occurs when the proceeds of a sale are less than the net book value. So in this case, our equation is in fact gain or loss on disposal equals proceeds from the sale minus net book value. So if the proceeds from the sale are less than the net book value, then when we subtract the net book value, we're going to get a negative number, indicating a loss. So if we assume the exact information is above, except the sales price is now $2,000, then, do I lay? No, I don't. So step 1, update any unrecorded amortization. Same drill as before. That doesn't change. Step 2, calculate the new net book value and loss on disposal. Now, when going in, you may not know that it's a loss, right? Like I'm writing it out as a loss here because I know it's going to be, because this is an example that I'm giving to you. You may not know that. So you may be going in blind at this point. First, calculate the new net book value, $35,000 minus $28,000 plus $2,500. So this, nothing changes here. Again, I'm writing loss because I already know it's a loss. You may not know. So, equals proceeds from the sale, $2,000 in this case, substantially less, minus whatever our new net book value at that exact date is, $4,500, is equal to, again, we put it in brackets, but it's actually negative. So it's negative $2,500. We put it in brackets to simulate the negative. Step 3, record the sale and the loss on disposal. So at this point, you should know whether you've made a gain or a loss, and this will dictate how you record the entries for that. So we still got money, even though we are at a loss. We still made money from the sale itself. So we debit the cash that we made. We also debit the accumulated amortization for the vehicle, same as before. Now in this case, we have a loss, and so we debit that loss because this is what affects owner's equity, and losses are debited, as you know. So we have the loss of $2,500. And then finally, to balance the whole accounting equation thing out, we credit the loss of the vehicle. Again, vehicle is an asset account, so we credit that account because it's a loss. We've lost the vehicle, and everything balances out nice and neat, and we've recorded our loss. And that is it. So that is all there is for the disposal of capital assets. Again, we don't go into the exchange just because it is terribly complicated and subjective, and we don't have time, so we're not going to go into it. But that is it. I hope you found this video useful, and I will see you in the next video. Okay, bye-bye.